Our last section here of Chapter 5 is going to be the 5.4 series of lectures called the flow of income and the circular flow diagram. Let's take a look at a couple more statistical pieces of information we need to understand. Here we're going to define national income. Now, by definition, the GDP minus depreciation will give us net domestic product. Let's go back and remind ourselves what these terms mean. Remember, GDP, gross domestic product, adds up everything that's been produced in our society, right? And then we make sure that we aren't double counting we don't add up the intermediate goods and things like that. But once we realize that issue, adding up all of the final goods and services, the consumer goods, the business goods, the investment goods that I'm talking about, government goods like firemen and teachers and things like that, all of those things, once you finally add them together, you get to the GDP. But remember, on a previous slide deck, we defined something called depreciation, and I used a trucking company as an example to recognize that even if you're buying a new truck every year, does not mean that the size of your trucking fleet will necessarily grow. If in fact you're losing a truck every year because they finally mileaged out and you got to get rid of it and buy a new truck, you might actually be staying in the same place. If trucks wear out every 10 years, if you have 10 trucks, then every single year one of them will be wearing out, right? So you need to have a new truck just to keep in place. So the whole point of this is to recognize that when we say the GDP is the total income of society and the total production, we realize a lot of that production, some of that production rather, is just being used to replace things that wear out. So it's not something you can take and actually go spending on fun things. You have to, if you're the owner of a trucking company, you can't take the money to buy a new truck and go out and just spend it on something. Otherwise, you'll eventually run out of trucks. So some of your spending is simply replacing worn out equipment. So we don't want to count all of the money that you bring into your trucking company as your money or profit. Some of it has to pay off the depreciation. So that's what this particular point is. So one thing we want to keep in mind is at the very top number we have GDP, the total gross domestic product. From gross, we subtract out depreciation to get net domestic product. Remember, the word net always means something's been subtracted from something else. So gross minus depreciation gives us the net. The net domestic product plus net foreign factor income gives us something called national income. So what's this fancy term, net foreign factor income? Well, we've already used the word factor of production before, so we know factors of production are things like land, labor, capital, entrepreneurship, and we've mentioned several of those things are sold to business people, and business people use those resources in order to make things, and so people get income from those things. So the first thing to recognize is the net domestic product is only measuring what's being produced on U.S. soil. But what if an American citizen, let's say an oil geologist, is working in Saudi Arabia for the Saudi Arabian oil company? And of course, he's being highly productive and discovers new deposits of oil. So that person earns income. So how do we keep account of that? Well, if one thing we want to know is, what do all Americans everywhere in the world earn? You would have to take the net domestic product of what we're doing here on American soil, plus you would have to add in what the Americans working in Saudi Arabia, Americans working in Singapore, Americans working in London, and add in their income as well. And what that gives you is national income, which actually you could think of it as national income is the same thing as what do your nationals earn, wherever they happen to be working at the moment. So national income, therefore, is the total income earned by U.S. factors of production, whether they're working in the U.S. or whether they're working in a foreign country. Now, to get from national income down to personal income, we're going to make a couple more subtractions. So let's go ahead and take a look at this. So from national income, once we finally figure that out, we subtract out several things, such as indirect business taxes, corporate profits, interest and miscellaneous payments, Social Security taxes, but then we add back in things like transfer payments. In other words, if someone collects a Social Security check, we count that as income to that person, okay? So we need to make sure that on one side we're subtracting out the Social Security taxes, on the other side we're adding them back in as a transfer payment. Also capital income. Capital income is the money you earn on your investment in a business or capital. This yields something called personal income. So from national income, we now get down to personal income. Now, personal income is your pre-tax income received by households. So this would be for all Americans, everything from hourly blue-collar workers collecting a check based on their hourly work, to salaries, to you're an investor and you receive dividends and you receive profits and capital gains. All the different ways there are to collect income gets captured in the personal income number. But this is before you pay your personal taxes. So what's our next word we're defining? Disposable income. Disposable income is what remains of your personal income after your taxes are paid. So think of it as disposable income is the money you can spend out of your check. The personal income would be the top number before they take the taxes out. Okay? And of course, we see on the next line we have a nice little formula for that. PI stands for personal income minus taxes equals disposable income. Now, disposable income turns out to be a very useful concept in a macroeconomic situation. If we want to know how much consumers can purchase in a country, we don't look at their personal income because a bunch of that is going to be taken away in taxes. We want to look at their disposable income. That's the actual money they can spend out of their personal income. Now, what can you do with your disposable income? Well, there's only two things that theoretically can happen. You either spend it as consumption or you save it. And of course, the two numbers have to add up to your total disposable income, so they always have to add up. Think of this. What if your disposable income is $1,000 a month and you consume 800 of it? Then how much was savings? Well, it has to be the remaining 200. You didn't take a lighter to the money and burn it, did you? So you saved it. Okay. But what if instead of spending 800 and saving 200, what if you spent 900? Then what would savings be? They'd be 100. But what if you're a real miser and only spent 700? Then what would your savings be? 300. So but you all recognize that the savings and the consumption have to add up to your disposable income because there's nothing else that can happen to income other than to consume it or to save it. And then of course, by definition, savings is that part of your disposable income not spent on current consumption. So saving is the generic term. What do we do with that money? As an individual, we usually put it in the bank. That's one of the #1 ways we do it. But then what does the money do sitting in the bank? It doesn't just sit there collecting dust, right? That money will be lent to business people, to homeowners, to governments, to spend, to borrow the money and spend it on things. So savings ultimately will be spent somewhere in the economy, even though you personally aren't spending it. You're saving it by definition, so you're not spending it. But that money through the lending process in the banking system will get back into the economy as people borrow it and they spend it. So let's go through some data now. Now this will get a little eye-watering, but don't worry, we'll try to make some sense out of it. In words, we've done it on the previous slides. Now let's look at it in numbers. From the year 2019 data, the gross domestic product, the total production of everything in our society, worked out to $21,427 billion. We've already seen that number before. Now, out of that total production, we had to set aside $3,463 billion just to replace worn out stuff. Worn out cars, worn out factory equipment, worn out ambulances, worn out tanks that the military is purchasing, all those things wear out. So we have to set aside money, so we don't want to count that as, oh, we can spend that money. So we took that out. That gives us the net domestic product. We add back in some income that Americans have earned working overseas. So that brings back $296 billion to add to our $17,964 billion of net domestic product, minus, well, this is a statistical discrepancy. This is a plug number because it turns out that, in fact, we oftentimes lose track of Americans overseas and don't really know what they're doing. So it's hard to accurately get that number. So 296 was the measured number, but that left things a little bit short. So the accountants plug in the discrepancy number. That gets us to something called national income. So this is the money earned by all American citizens wherever they're working in the world, whether in the US or working in a foreign country. Now, we subtract out of several things called, some we talked about before, less indirect business taxes, less meaning taking out or minus corporate profits, minus interest and miscellaneous payments, minus Social Security taxes, because these are all business-related issues. Plus, we add back in transfer payments like collecting a Social Security check, and then capital income that you would receive as an individual, and this gives us personal income. So this would be the income that families actually receive in one way or the other, either as wages, salaries, interest that they've earned, capital gains that they've earned, dividends on their stocks. Those are the different kinds of things that you can actually earn as an individual. And then, of course, you have to pay taxes on that money. So we Americans paid $2 trillion and change in taxes on $18 trillion worth of personal income. So that's just a little over 10% of personal income is spent on personal taxes. That leaves $16 trillion of disposable income. So in the United States, actual spendable cash works out to about $16.42 trillion dollars in the United States. So we got from gross domestic product all the way down to disposable income. Now, let's take a look at our income summary. Households receive personal income as payments for the resources they own and provide. Whether it's as labor resources, capital resources, you own land, you rent it to a farmer, you own a coal deposit and you sell the coal, all the different ways that you can either collect money from your own labor, or you can collect money from the natural resources you own, or from the capital equipment you own. All of that is now your personal income. How do the households dispose of that income? Because now it's disposable income, and how are they going to get rid of it? Well, we get rid of it through three main mechanisms. You get rid of it by spending it on goods and services. You out and buy that new Mercedes, you obviously are going to give up some of your income. Or if you didn't spend all of your income, then the remainder will be saved, and then of course you also have to pay taxes. So all three things together, personal income ultimately is broken down into you either consumed your personal income, you saved it, or you paid taxes with it. Okay? So the three numbers C plus S plus T have to add up to personal income in one way or another, because obviously anything you didn't consume either ended up in savings or ended up in taxes, one or the other. Now let's take a look at what's called the flow of income. So GDP now, since we've defined it mostly as a production number, now we recognize it's also the income number. Let's take a look at where does all that income go to on the income side. So to households, it comes in the form of disposable income. And then through the circular flow diagram, what do households do with that income? They return it to the GDP by spending it on consumer goods, the letter C that we talked about on the expenditure side. And then to businesses, when they get their income, they have what? In the form of retained earnings and depreciation allowances, they now return it to the GDP in the form of business investment expenditure or spending. So as a practical example, picture a construction company saying, we need a new bulldozer, let's go ahead and buy that. Now, buying that bulldozer means workers at Caterpillar now have something to work on, and therefore they produce the bulldozer, and that's how production and the spending end up getting linked together. And then, of course, some of that income, now part of that GDP, goes to the government in the form of taxes, and then that gets returned to the economy as the government spends it on hiring a new fireman, hiring a new nurse, if they have a government hospital, like the VA hospitals, they're government nurses, government pays for teachers, government pays for a whole bunch of things. And so that money gets back into the economy through government spending. So the circular flow diagram reminded us that, in fact, all income that's produced has to return to the economy as spending in some form. And we see it on this particular slide. We've already done, this is a more complicated version of the circular flow diagram, but you notice in the bottom greenish blue circle, we have factor markets. Remember, households are on the left-hand side. They're bringing they are bringing the factors of production to the factor markets. The factor markets, that's where business people come to purchase labor and materials and things like that. So that all goes to the business firm. The business firm spends that money in the product in producing the products, and then of course the income that households receive ends up going to in consumption. So ultimately, this is where that concept of a circular flow comes from. Money that starts off in production ends up as income. The income ends up as spending. The spending ends up end up in the production because people have to produce for the spending, and that causes income. And so you see that makes a continuous flowing circle of both production and income. And then last thing to talk about on the issue of GDP. Now we're going to do a little bit more philosophical issues. Will more GDP make us happier? That's another way of simply asking the question, will more income make us happier? Well, it does to a certain degree, but of course, more income doesn't guarantee happiness in any way. Richer people are not always happier than poorer people. I mean, there's lots of happy poor people and lots of really bitter, sad, angry rich people. So it doesn't make you happier, but it certainly contributes to it. GDP accounts tell us anything. Do they tell us anything about quality of life? Yes. It's one of the best measures of the standard of living because GDP is also measuring income, and income pays for most of the things that enhance the standard of living. Having a nice home that keeps the rain off you, and a nice air conditioning system that keeps the heat off of you, and having nice food so you're not hungry, having nice clothes, having nice medical care, having nice educations, those are all nice things. It's really hard to argue to people that, well, you shouldn't have more income because you're not going to be happy with it. It may not make you happy, but it certainly contributes to most people's idea of what happiness is. However, the GDP does not measure intangible pleasures of life, does it? It doesn't measure how well your church is operating. It doesn't measure your spiritual well-being. It doesn't measure how well you get along with your adult children. It doesn't measure how well you get along with your spouse. I mean, there's lots of things GDP can't measure that are also important for happiness. So the only reason we're bringing this up is sometimes people get too obsessed on GDP numbers as if GDP is the only thing that counts. But then we also don't want to make the opposite argument that says, oh, money doesn't make you happy, therefore who cares what the GDP is? We have a country that is incredibly low GDP and people have incredibly low monies, but they're happy people. Well, how happy are they? You do notice, I hope, that when we talk about the United States, and it's also true for Europe, people from poor countries, do they spend a lot of time trying to keep Americans out of their country, or are they trying to get into the United States? Why are they doing that? Well, because they make a higher level of income. So unless they're all crazy, and since they all can return back to their country and they choose not to voluntarily, they have to get deported to get them out of the country, it shows that, in fact, higher incomes for the vast majority of people definitely contribute to your well-being. So we don't want to underplay how important having a very productive society that generates a lot of income is. But again, we don't want to make it the only thing people care about either. So this is just that philosophical issue that you all need to constantly keep at the back of your mind when we're discussing GDP issues.